For most people, financial crises arrive loudly. Markets crash on live television, banks close their doors, politicians rush to microphones. But what if the next crisis doesn't arrive that way? What if it doesn't announce itself at all? What if right now a major credit collapse is already happening quietly, slowly, and out of public view while the biggest investment funds in the world are already trapped inside it? Because that is exactly what many experts now believe. Not that a collapse is coming someday, but that it has already begun. And the most dangerous part is not the losses themselves, it's the silence around them. For years, investors were told that modern finance had learned its lessons, that risk was better managed, that leverage was under control, that sophisticated funds, advanced models, and private markets had made the system safer. But history shows something uncomfortable. Every major crisis begins with confidence, and every major collapse starts in places most people are not watching. To understand what is happening now, we have to rewind, not just a few years, but decades. Because this silent credit collapse didn't start with one bad decision. It started with a system that slowly taught itself to depend on debt. After World War II, credit was simple. Banks took deposits and made loans. Risk was visible. Failures were local. But as economies grew, finance became more complex. New markets formed, new instruments were created, and over time debt stopped being just a tool for growth and became the foundation of growth itself. By the late 20th century, credit markets had expanded far beyond traditional banking. Bonds, leveraged loans, securitization, private lending, derivatives, each layer added efficiency, but also distance. Risk became harder to see. Losses became easier to delay, and responsibility became easier to shift. The real turning point came after the 2008 financial crisis. Governments cracked down on banks, capital rules tightened, risk-taking was restricted. On the surface, this made the system safer, but beneath the surface, something else happened. Credit didn't disappear. It moved. Instead of banks, private funds stepped in. Asset managers, private equity firms, hedge funds, pension-linked vehicles, and private credit funds began doing what banks could no longer do. They lent money, they structured deals, they financed companies, and they did it outside the public eye. At first, this shift looked harmless, even healthy. These private markets were praised for flexibility and innovation. Investors loved them because returns appeared stable. Companies loved them because money was available, and regulators largely ignored them because they weren't technically banks. But this is where the first hidden cause was planted. When credit moves into the shadows, transparency disappears. Prices stop updating daily. Losses stop appearing immediately, and risk stops being obvious. For years, low interest rates masked these problems. When money is cheap, debt looks manageable. Bad loans can be refinanced. Weak companies can survive. Losses can be rolled forward instead of recognized. This environment rewarded borrowing, punished caution, and encouraged leverage. As more money flooded into private credit and leveraged markets, standards declined, deals became riskier, protections weakened, debt loads increased, but performance still looked smooth because nothing forced the system to confront reality. That confrontation began when interest rates rose. Suddenly, the math changed. Companies that had borrowed cheaply now faced higher payments. Refinancing became difficult. Cash flows tightened. At the same time, economic growth slowed. Costs rose. Margins shrank. And the system that depended on constant, easy credit began to strain. This is where cause turns into consequence. Higher rates increase interest expenses. Higher expenses reduce cash flow. Reduced cash flow leads to missed payments. Missed payments trigger restructuring. Restructuring delays recognition. And delayed recognition builds hidden losses. This is why the collapse is silent in public markets. Prices fall quickly. In private credit, prices don't fall at all until someone is forced to sell. Instead, funds use models. They smooth valuations. They assume recovery, they extend terms, they amend and pretend. But reality does not disappear just because it is postponed. As defaults slowly rise, funds face a problem they were not built to handle: illiquidity. Investors want their money back, but the assets cannot be sold. ISLA loans are private. Buyers are scarce. Prices are uncertain. So funds restrict withdrawals. Redemptions are delayed. Capital is trapped. This is already happening. Large funds are quietly gating investors. Valuations are being adjusted in small increments. Losses are being spread over time, and confidence is being maintained barely. But the deeper problem is structural. These funds promised the liquidity while investing in liquid assets. They assumed calm markets. They assumed refinancing. They assumed stability. Those assumptions are now breaking. The breaking point in any credit system comes when confidence shifts. Not when losses appear, but when people realize losses cannot be avoided. When refinancing fails, when restructuring stops working, when cash flow can no longer cover debt, at that moment, silence ends. The fallout from a silent credit collapse is not dramatic at first. It shows up as underperformance, as delayed payments, as frozen funds. But over Chimi, the damage spreads. Pension funds face gaps, insurance companies face pressure, banks face counterparty risk, credit tightens further, companies cut jobs, investment slows, and what began as a quiet credit problem becomes a real economic one. This pattern is not new. In the past, similar collapses appeared in savings and loan institutions, emerging market debt, mortgage-backed securities, and structured credit. Each time, the story was the same. Innovation created distance. Distance hid risk. Risk accumulated quietly. And when conditions changed, the system cracked. Today's version is private credit and leveraged finance. What makes this moment especially dangerous is scale. This market is enormous. Trillions of dollars. Deep connections to retirement systems, exposure across industries, and limited transparency. The usual fixes are also weaker. Central banks can lower rates, but inflation limits their ability. Governments can intervene, but political appetite is low, and private funds are not easily rescued. That means losses must be absorbed somewhere. And that brings us to the present. We are now in a phase where stress is visible to insiders, but invisible to the public, where funds are trapped by their own structures, where capital is locked, where exits are limited, and where confidence is fragile. The silent nature of this collapse is what makes it dangerous, because when it finally becomes loud, it will already be advanced. So what are the lessons? First, stability without transparency is an illusion. Smooth returns often hide growing risk. Second, debt systems depend on conditions staying favorable. When those conditions change, leverage turns from fuel into fire. Third, delayed losses are not avoided losses. They accumulate. The warning is simple. The next financial crisis may not begin with a crash. It may begin with silence, with gated funds, with quiet right, with trapped capital. And by the time everyone notices, choices will be limited. If you want to understand what is really happening beneath the surface of global finance before it reaches the headlines, stay with us. Subscribe, follow, and keep questioning the stories that sound too calm to be true. Because the most important collapses are often the ones unfolding quietly,